Welcome to Market Pulse, the podcast that deciphers market flows. Hello, everyone, and welcome back to Market Pulse, the podcast that unveils the secrets of financial markets with sharp insights and a touch of wit. Today, we're diving into the world of systematic flows and institutional investor positioning. We'll cover CTAs, risk parity, equity vol control, and leveraged and inverse ETFs, everything that moves the market before the market even realizes it. CTTAs, trend followers in limboctas, those masters of trend following, seem to have reduced their long positions on the S&P 500 and NASDAQ 100. But hold on, they haven't started building heavy short positions yet. According to BofA, if markets continue to decline or stay at current levels, the big short wave could begin within a week. Tick-tock, tick-tock. Meanwhile, Euro Stoxx 50 remains their favorite long play, while Russell 2000 and Nikkei 225 are seeing increasing short positions. In bonds, CTAs are closing their short bets on U.S. Treasuries, but they might ramp up short positions on German bunds. On the commodities front, BofA's model sees short positions on crude oil increasing, while gold, which has bounced back, could continue to enjoy CTA support. And in FX? Well, last week, the U.S. dollar saw its biggest weekly drop since November 2022. The result? BofA's model has closed its short position on the euro, and the next move could be a reversal. Long EUR and GBP with further buying in the Japanese yen. S&P 500 gamma. A fragile balanced gamma on the S&P 500 has remained minimal this week, peaking at just $1.6 billion and recording a modest +0, $2 billion on Thursday, 7th percentile. Not exactly the perfect storm, but rather an eerie calm before something bigger. Here's the deal. The gamma profile is highly asymmetric. Short-term options, 1 week to 1 month, are heavily skewed to the upside. Translation? If the S&P 500 drops, gamma stays stable. But if the index starts climbing, we could see a gradual gamma recovery reaching -4 billion near 6,050. Risk parity. Still highly leveraged. Despite rising equity volatility, BofA's risk parity model leverage remains high. What's happening behind the scenes? Allocators are increasing bond positions, probably in search of stability. At the same time, they are reducing equity exposure. Is this a sign of risk aversion or just a strategic move to navigate the storm? We'll find out soon. Equity vol control. Leverage retreats equity. Vol control strategies have reduced their leverage in recent days due to rising stock market volatility. In short, when the sea gets rough, the most cautious ships lower their sails. But if the market stabilizes, we can expect a return of equity exposure. Leveraged and inverse ETFs. The market's turbo boost. How much can leveraged and inverse ETFs move the market? Let's break it down. For every 1% move in the S&P 500, these ETFs could generate $750 million in buying or selling. On the NASDAQ 100, the impact is even bigger, up to $1.6 billion per 1% move. However, the amount of S&P 500 and NASDAQ 100 futures these ETFs should theoretically trade per 1% move has declined over the past week. Why? Because the spot price has dropped, reducing the need for rebalancing trades. Conclusions: what to expect? If markets remain at current levels, expect CTAs to start building aggressive short positions. Keep an eye on volatility. If it keeps climbing, risk parity might see a correction, and equity vol control leverage could stay low. Finally, with the dollar weakening, European currencies might benefit from renewed interest. Plenty of moving parts, and as always, we'll be here to break them down for you. That's it for today. If you enjoyed this podcast, leave a like, subscribe, and turn on notifications so you never miss our next market breakdown. We'll be back soon right here on Market Pulse.